In this video we are going to talk about 10 dividend stocks that will pay your rent. So before starting, please like this video and subscribe to this channel for our future updates. The periodic distributions are treated as a retirement paycheck by many. After all, $1 million in the bank is useless unless removed. Diversification is the process of diversifying your assets. As a result, your family's budget is more stable. Take a look at these 10 dividend stocks that will pay your rent. Number 10. Southern Co. Regulated utilities provide significant dividends and have predictable growth rates. A large percentage of retirement portfolios contain utility equities. Southern Company, so $66.05, has been paying dividends continuously since 1948. The company serves 9 million people in the Southeast and Illinois. While Southern has had some recent setbacks due to delays and cost overruns on clean coal and nuclear projects, the company is nonetheless financially sound. However, compliance requirements may be less painful for shareholders than expected, and may even increase profitability due to rate base expansion. We expect regulators to let Southern pass on most of the extra costs to customers, preserving its long-term profitability. Southern's payout ratio is near 80%, greater than most regulated utilities. The firm's nuclear power reactors will be completed in the next few years, allowing SO to maintain and increase its dividend while enhancing its coverage. Number 9. Consolidated Edison. Consolidated Edison, ED, $77.86, was founded in 1823 and serves 10 million customers in New York City and nearby areas. Regulated utility operations provide roughly 90% of earnings, ensuring consistent returns over time. CONE has raised its dividend for 47 years in a row, owing to New York's ongoing energy needs. It's the longest streak of annual dividend hikes among S&P 500 utilities. Consolidated Edison's dividend streak appears set to continue. The business intends to grow EPS by between 4% and 6% annually over the next 5 years, led by significant infrastructure expenditures surrounding New York City. Standard & Poor's gives the utility stock an A investment-grade credit rating. This should help the company deal with regulators who questioned its reaction to a tropical storm in 2020 that caused massive power disruptions. Number 8. Washington Trust Bancorp. Washington Trust Bancorp, WASH 52.98, is a bank in Washington, D.C., but don't let its small stature fool you. Washington Trust is America's oldest community bank and Rhode Island's largest state-chartered bank. In addition to financing, Washington Trust earns a lot of money from wealth management and mortgage banking services. These businesses generate more consistent revenues over time. In reality, despite the country's first recession since the 2007-09 Great Financial Crisis, the bank's earnings grew in 2020. Even if profits plummeted, the bank would be well capitalized to protect the dividend. It appears that even in a severe worldwide recession, Washington Trust would have enough surplus capital to keep paying its dividends without endangering the firm. Since 1992, the bank's dividend has been maintained or increased. Washington Trust is a relatively unknown financial income play. Number 7. Pinnacle West Capital Corporation. Pinnacle West Capital, PNW, $85.61, Arizona's largest and longest-serving power company, is the state's largest and longest-serving power company. About half of the energy used by the regulated utility comes from clean sources. Pinnacle West's footprint is interesting because Arizona is the third fastest-growing state in the U.S. As a result of the pandemic, the company's retail client base grew by 2.3% in 2020. Pinnacle West has paid dividends for almost 25 years, thanks to supportive state regulators, an A corporate credit rating, and a sustainable payout ratio that has been maintained below 70% for over a decade. Income investors have also benefited from 9 years of wage increases, including a 6.1% increase announced in October 2020. That tendency appears set to continue. As a result of increasing renewables investment supported by a favorable clean energy regulatory environment, says CRA analyst Andrei Tomchik. Number 6. Duke Energy. Duke Energy, Duck, $100.54, pays a stable dividend. In reality, the regulated utility has paid a cash dividend on its common stock for 95 years running. Duke is among the best recession-proof stocks on Simply Safe Dividends list. In 6 Midwestern and Southeastern states, the corporation serves 7.8 million retail electric customers. Duke Energy serves about 1.6 million customers in the Carolinas, Ohio, Kentucky, and Tennessee. Most of these areas have good regulatory links and stable demographics. Duke's dividend is supported by the company's investment-grade credit rating and has big expansion plans in the next few years. If all goes well, Duke's dividend should increase by 5 to 7% per year through 2025. Number 5. Monmouth Real Estate Investment Corporation. Monmouth Real Estate Investment Corporation, MNR, $19.30, is one of the world's oldest publicly traded REITs. Monmouth's 121 industrial properties are leased long-term to predominantly investment-grade tenants, 82% of revenue. Home Depot, Kellogg, and Coca-Cola are among Monmouth's tenants. The average age of Monmouth properties is slightly over 9 years. Its properties are also near airports, transportation hubs, and manufacturing plants, which are vital to its tenants' operations. These features have sustained portfolio occupancy at 98.9% since 2016 and enabled the REIT to collect nearly all the rent. Due to its cash-rich business style, Monmouth has paid dividends for 30 years in a row. But dividend growth is unpredictable. After a 6.25% increase in October 2017, managers held the dividend steady until a 5.9% increase in January 2021. Monmouth's dividends should remain safe and somewhat increase in the coming years. The REIT has a low payout ratio and is increasing funds from operations. Number 4. Toronto Dominion Bank. Toronto Dominion Bank, TD, $70.64, is a major bank in Canada. The bank's revenue is split between fee-based businesses like insurance, asset management, and card services. Unlike most large banks, TD has less exposure to riskier, more cyclical areas like investment banking and trading. TD's vast reach and retail network have supplied it with a huge base of low-cost deposits. This enables the company's lending activities to earn a healthy spread and allows the bank to offer new products. Management is also conservative. TD's capital ratios are considerably above regulatory minimums, allowing it to absorb loan losses during downturns without endangering the dividend. Standard & Poor's rates the bank AA-. Dividends have been paid to shareholders since 1857, making TD one of the oldest dividend payers and a member of the Canadian Dividend Aristocrats. Number 3. Old Republic International. Old Republic International, ORI, $25.93, has not only maintained its dividend for 79 years, but has increased it for 39 of those years. Given the industry's cyclicality and fierce rivalry, such a track record is commendable. Workers' compensation, trucking, home warranty, and other lines of business make up nearly half of Old Republic's business. Underwriting profit has been created by Old Republic's general insurance activities for 14 of the last 15 years. Title insurance requires little capital and has low losses, allowing for great revenue diversification and decreasing underwriting volatility. With a solid payout ratio below 50% and enough capital to weather practically any potential downturn, Old Republic is set to continue growing its dividend for years to come. Profitability enabled a significant special dividend payment in January 2021. Number 2. Omnicom. Omnicom, OMC, $84.30, has paid dividends continuously since 1986, when it merged 3 significant advertising corporations. The advertising and marketing firm has over 5,000 clients in 70 countries. No industry generates more than 16% of total income, and over 45% of sales are generated outside the US, ensuring global diversification. Many clients want to deal with only a few agencies to maximize their negotiation power and marketing budget efficiency. Omnicom, one of the world's largest agency networks, is uniquely positioned to serve worldwide clients. While the global advertising business is expected to grow along with the economy, Omnicom must retain strong client connections and change its portfolio to be relevant. The rise of digital media has led to more consolidation inside the ad space, writes Ali Magharabi, senior equity analyst at Morningstar. Omnicom and its peers have acquired several smaller agencies focused on the growing digital advertising niche within the overall ad space. Number 1. Public Storage. Public Storage, PSA, $275.21, was founded in 1972 and has paid dividends continuously since 1981. Self-storage warehouses provide high cash flow due to cheap operation and maintenance expenditures. Few clients are prepared to move to a rival facility to save money, resulting in switching costs. And customers have traditionally prioritized storage rent payments. The law delinquency rate was approximately 2% during the Great Recession of 2007 to 2009. In April 2020, the COVID-19 epidemic impacted public storage similarly. The self-storage business in America is experiencing a surge in supply, making it harder to attract consumers and raise rent. But PSA has a solid balance sheet and should continue to pay dividends for years to come. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.